Hey everyone, and welcome to this explainer on Toyota's strategic position and overall financial health. Today is August 23rd, 2026, and we're going to unpack exactly what is happening right now beneath the hood of the world's largest automaker. Just for some quick context as we look at these numbers today, Toyota's OTC stock, trading under the ticker TOYOF, closed at $19.12 on August 21st. We've got a lot of really fascinating ground to cover, so let's jump right in.
The world's biggest automakers are fighting a war over electric vehicles, but Toyota made a very different bet. That statement right there, that is the fundamental hook of our entire analysis today. In an industry that has literally been racing at breakneck speed toward a purely electric future, Toyota made a highly contrarian decision. They just flat out refused to go all in on battery EVs right out of the gate.
Section 1. The controversial hybrid bet. Now, what's really interesting about this approach is that Toyota's strategy isn't just EV or nothing. Instead, they're deploying a highly flexible, multi-pathway strategy. They are heavily investing in your standard hybrids, plug-in hybrids, battery EVs, and even hydrogen fuel cell tech. Honestly, this flexibility is brilliant. If consumers aren't quite ready for full EVs, because of range anxiety or gaps in the charging infrastructure, well, Toyota has a massive lineup of hybrids ready to roll. But if the EV market suddenly accelerates, they're still actively developing those battery EVs. They simply aren't locked into a single point of failure.
And we definitely have to remember who we're talking about here. Toyota is not some scrappy little challenger brand trying to carve out a niche for itself. They aren't just selling cars in a few trendy cities. They are manufacturing and selling all over the map. Japan, North America, Europe, Asia, Latin America, and the Middle East and Africa. This massive, diversified global scale is absolutely one of their biggest competitive advantages. They don't have to rely on just one single market to keep the lights on.
Section 2. The Profit Paradox.
Let's look at the first half of fiscal year 2026. Sales revenue hit a staggering 24.63 trillion yen. That is up 5.8% year over year. Sounds incredible, right? But wait, dig a little deeper and you'll see operating income actually plummeted 18.6% to 2.01 trillion yen. Net income to Toyota also fell by 7%. This right here is a stark, flashing warning sign for us.
So the absolutely crucial point is this. Revenue is growing, but operating profit is falling. Toyota is for sure not struggling to sell vehicles. Top-line demand is demonstrably there. Their fundamental issue right now is severe pressure on their profitability.
So why exactly is this happening? Well, it's because enormous costs are pressuring their margins, and these costs are rising way faster than their revenue. We are talking about across-the-board inflation. Steel, batteries, semiconductors. Basically, if it goes into a car, it costs more right now. We're seeing rising costs in labor, logistics, running the actual factories, and of course, the massive R&D required for that multi-pathway strategy we talked about earlier. Plus, as we're going to see in a second, there's the looming shadow of tariffs. This perfectly proves why you've got to monitor operating income way more closely than just headline sales numbers.
Which naturally leads us to the ultimate question every investor needs to ask themselves before putting a single dollar into this stock. How much profit does Toyota actually keep from each sale? I mean, if it costs them increasingly more to build and ship the vehicles, all that revenue growth is kind of just a vanity metric.
Okay, let's dive into Section 3, Global Threats and Risks.
First step on the risk board is U.S. trade policy. The United States is historically a massive profit engine for Toyota, but tariffs present what we can call an uncomfortable triangle. Here's how it works. Step 1. Tariffs increase the baseline cost of the vehicles or the parts needed to make them. Step 2. If Toyota absorbs that cost, their profit margins shrink even further. But if they pass those costs on to the customer by jacking up the sticker prices, well, step 3, vehicle demand inevitably weakens because cars just become unaffordable. It's a really difficult balancing act.
And this geographic pressure only compounds when we look over at China. Toyota is facing intense pressure from local Chinese manufacturers. Think brands like BYD and Geely. These domestic brands are rapidly dominating their home market with lower-cost EVs, incredibly fast software development cycles, and super aggressive pricing. This is a crucial real-time test to see whether Toyota's vaunted hybrid advantage could actually become a disadvantage in a rapidly electrifying regional market.
We also have to factor in currency fluctuations. Remember, Toyota reports its financial results in Japanese yen, while the Toyo-F OTC stock we're discussing trades in US dollars. If the yen strengthens, Japanese exporters like Toyota generally become less competitive globally. Conversely, if the yen weakens, all those overseas earnings translate into a whole lot more yen back at headquarters. The key takeaway here for US investors is that Toyota's operational performance does not automatically equal your dollar return. Currency acts as this silent modifier in the background.
So, to quickly summarize this with our risk scorecard, tariffs are sitting at a high risk. The EV transition, competition in China, and margin pressure all sit at a medium-high risk. Also, keep in mind that OTC liquidity is a high risk since Toyo-F is an over-the-counter security with delayed pricing. Overall, the risk profile here is definitively medium-high.
And this brilliantly illustrates Section 4. Rewarding the shareholders.
Now, despite all the margin pressures we just went through, there is a very consistent upward trend in shareholder distributions. Look at this. In FY 2025, the dividend per share was 90 yen. In FY 2026, it grew 5.6% to 95 yen, and the official forecast for FY 2027 is 100 yen per share. That's another 5.3% increase. They are steadily putting more cash directly into shareholders' pockets year over year.
And it goes way beyond just the base dividend amount. Investors are benefiting from increasing payout ratios, moving from 32.1% in FY 2026 to a projected 39.8% in FY 2027. On top of that, in August 2026, Toyota highlighted a massive 1 trillion yen share repurchase and treasury stock retirement program. Essentially, they're aggressively shrinking the overall share count, which makes every remaining share that much more valuable.
You're probably wondering, how on earth can they afford all this while their operating income is dropping? Well, it's because their operating cash flow jumped from 3.70 trillion yen in FY 2025 to an absolute staggering 5.47 trillion yen in FY 2026. Honestly, this massive jump is one of the absolute strongest numbers in the entire Toyota thesis. It gives them the sheer financial capacity, a literal war chest, required to survive the turbulence of the EV transition.
Which brings us to Section 5, the final verdict.
Here is our definitive conditions-based verdict for navigating this stock. We rate Toyota a buy on pullback if the stock price corrects due to some temporary market fear. That gives you a great chance to buy quality at a reasonable valuation. It's a very solid hold for existing investors, just as long as Toyota maintains its global scale and that robust cash flow we talked about. You definitely need to watch very closely for any shifting tariff policies, further margin degradation, and how the whole situation in China plays out. And finally, a sell or reduce trigger would be if we keep seeing this deadly combo, revenue going up, but operating profit and overall market share both definitively dropping.
When we summarize Toyota's fundamentals on a 5-star scale, their strengths are blindingly obvious. They pull a perfect 5 stars for global scale, brand power, hybrid technology, manufacturing prowess, cash generation, and their pristine balance sheet. But their weaknesses are equally clear. They score only a 3 out of 5 for their current EV market position and their overall growth metrics.
So, tallying all of this up, we give Toyota a final overall rating of 8.8 out of 10. The fundamental business mechanics, the sheer scale, and the cash flow are incredibly strong. However, like we've detailed, it does remain a medium-high risk play, mostly thanks to those macroeconomic headwinds, margin pressures, and the brutal reality of an electrifying automotive landscape.
Before we wrap up, I want to leave you with this final, somewhat provocative thought to chew on. Toyota doesn't need to win the EV race tomorrow. It needs to remain profitable while the automobile industry decides what the next decade of transportation actually looks like. Could it be that Toyota's controversial hybrid bridge is actually the smartest, most pragmatic bet in the entire global industry? Thank you so much for joining me for this explainer, and I really hope this deep dive helped bring the reality of Toyota's strategy into clear focus for you.